All right, so here's the monthly chart. And looking at the monthly time frame, I want you to see that kind of like this will be somewhat of a review. Also, showing you an example how you might want to journal. So you want to bring in your own unique personality to this. I'm just giving you the basic approach to annotating your chart and how you might record some observations. But you might want to include a lot more self-love. Okay, something that you might want to do in your annotations is really write in those types of comments that you saw it coming. Even if you didn't really see it coming, you're conditioning your subconscious by recording these pseudo experiences. That way you're tricking your brain into seeing something at a later time, referring back to these as examples like on the weekend, or say a couple weeks ago, you'll look at your journal. And by looking at them with these annotations and reading them out again, your brain sees these PD arrays. And the PD arrays are things like the fair value gap here, the breaker here. And you're probably asking yourself, how could this be a breaker? Well, we had a high here, we dropped down, and then we went higher. On the lower time frames, this would look obvious as a breaker. But this is also a down close candle prior to this run up. So essentially it is a mitigation block. Breakers are mitigation by default. So whether you identify that as a breaker, which it is, or if you just want to refer to it as a mitigation block, you would be correct in either case. The high of that candle is the monthly bearish breaker high, and the low of that candle is the monthly bearish breaker low. This candle's low and this candle's high makes the fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency. It means it's a down candle that creates the fair value gap. A very short way of saying it. The market creates a fair value gap here in the form of a buy side imbalance, sell side inefficiency. This candle's high to this candle's low. The fair value gap was formed with buy side delivery. In other words, it's an up close candle that makes the fair value gap. This is something future. This is something that's already happened. So over in the annotation section, this is something that I would humbly submit. Now, obviously, I've seen some of my students that are extremely detail-oriented, and they're absolutely stunning in terms of how they annotate their charts, how they record their observations, just the overall neatness and well-rounded presentation of recording what it is they see in the chart that's useful to them. Just a beautiful illustration and approach to doing it. And many of them share by way of Twitter. And while I do believe that this part of your journey should be kept private, you want to include over here some of the personal things that you want to include for that particular time frame or that market. This is also why I teach that you should only really be focusing on specializing on one market. Now, you might have support behind the very market that you're trading by using the dollar index, for instance, and that serves you well, whether it be an index trader like I'm showing an example of here, or a forex trader, and or a commodity trader, because the dollar index is going to have a lot of impact on all three of those types of markets. But in your annotations, for instance, I'll just read this out here. The NQ monthly journal entry. The NQ monthly continuous contract has rallied strong from October 22 lows right here. Why did this rally from here? You can include that it traded down into this buy side imbalance, sell side inefficiency, which is a fair value gap, and swept the sell side rate below that low. That's how much you can include. You can include all this in here, but for the sake of brevity, and also just to review and also show you what might happen going in the future from the time of this recording, I'm only including what's salient right now. I was anticipating the down close candle on September of 2021 to provide characteristics of a ICT bearish breaker. That's this candle I'm referring to there. It was long overdue for a down close monthly candle after 5 months of buy-side delivery and price. That means all of this movement here. So it's reasonable to anticipate at the time of this recording, it's August 2023. So we traded up, 5 months being from this down close candle. So you have 1, 2, 3, 4, 5. And then in August, because this is July here, August, it's reasonable to anticipate August creating a down close candle. It does not need to close lower, but we can anticipate the delivery of price like this because we've had so many up close candles, and we traded up into a breaker, and we fulfilled the redelivery to all this down close candles range between this candle's low and this candle's high. It's going lower, right? Well, inside that shaded area, we expect price to deliver upside or buy-side delivery. Not buy-side liquidity, buy-side delivery. That means just movement higher to overlap this area over here. When it painted lower, you want to see candles painted higher. So that gives us a repricing, not necessarily rebalanced yet. It has to leave this area on the lower time frames to be rebalanced. So notice what I said here. I said that I was anticipating the down close candle on September 2021 to provide characteristics of a ICT bearish breaker. Now this statement was true for me personally, but for you that might not be the case. Referring to that candle, you may not have even referred to that candle at all in your analysis. You may not even noticed it or paid any mind to it. In your charts, when you're back testing and journaling, you're going to be doing this very thing here. You're going to be recording it as if you did. You're going to use language like this. I was anticipating the down close candle on September 2021 to provide characteristics of an ICT bearish breaker. What this is implying is you felt when it reached up into this area in here, between these two heavy red levels, that there would be some measure of a draw to it. And then where inside between these two levels here, the breaker low and the breaker high, where is their liquidity? Well, that would be right above these highs here, which are relatively equal. And you have the inefficiency in here. So is it required for price to come all the way up to the breaker high? We don't want to see that. That's one of the rules about that pattern or that very PD array. We don't want to see it trade to the high. It can, but we don't want to see that. So in this range here, we see the inefficiency, and we trade up into the breaker, this down close candle. And in your chart where you have spaces, or you at least have to make spaces in your chart, so you have to scale your time axis and your price axis to allow where you can annotate. Now for me, this is enough to give you an example. But I want you to take away from this the language I'm using here. I am very pleased to see price open near the high of the present August 2023 monthly candle, subsequent delivery of lower price. The NQ is showing respect of the January 2022 fair value gap SIBI, which is located inside the range of the ICT bearish breaker, meaning that I'm pleased that it's doing this very thing. This is a monthly candle for August of 2023. It opened, moved up just a little bit. It's barely very hard to see. But then it trades lower after trading into and closing in the month of July this fair value gap SIBI. That's what this is saying here. And notice what I'm using again. The terms that are very emotionally positive. And here I say if NQ finds its way lower and below the ICT breaker low, there's a fair value gap BISI formed on the June 2023 monthly candle. That's this candle right here. Now, over here in this area, you may include other things that you were identifying or saw something in here that you want to make sure you record and build up this scary area in your understanding. Longer term bias. How long should I expect the bias to stay in effect? Well, if you've been bullish, it's reasonable to anticipate it eating up into this bearish breaker. And if it does, how far can it go? Buy sides here above these highs, and then you have the inefficiency. And you saw July deliver that, and the wick goes just past it by a little bit, but that's okay because the wicks do the damage. The candlesticks tell you the story. That's the narrative. Now, taking everything from that monthly chart, transposing it down to the weekly chart. It's very easy to do that. You just toggle down to the weekly chart. And every annotation that you have, as long as each one of these annotations that you did on your monthly chart are shown on all intervals. So the way you would do that is you would hover over top of any annotation, then right-click your mouse, and then click interval or show intervals all on TradingView. And that way, every time you drop down to a lower time frame or any other time frame, the annotation you put on your higher time frame monthly chart will show up on the lower time frames all the way down to the smallest one. So what I have here is those same breaker high, breaker low, and fair value gap on the monthly. So you want to annotate your higher time frame PD arrays with what time frame they are. Notice I have the monthly bearish breaker high, monthly fair value gap SIBI, monthly bearish breaker low. This is a premium wick consequent encroachment. That means this wick of this candle here, it's half of that wick. We treat wicks and tails on candlesticks like gaps. Okay, so every gap has a equilibrium price point. And it's not called mean threshold. It's not called equilibrium. It's called consequent encroachment. So whenever we have a gap, like this box is here, that would have a consequent encroachment as a midpoint. An order block, which is like the breaker high and the breaker low that was shown on the monthly chart. Let me go back up. This candle here, midpoint of that, because it's an order block, midpoint is mean threshold. Middle or halfway point of a gap, fair value gap, the halfway point would be consequent encroachment. So now we're on a lower time frame weekly chart. So now we can start seeing more detail. This price action here, on this very particular candle, we have a wick. That wick, project that out in time, it is a premium wick consequent encroachment. Now when we drop down to the lower time frames, which will be the daily and subsequent lower time frames, this would have to be annotated as what? What time frame is this? Weekly. This is a bullish order block, propulsion block. Why is this a propulsion block? Because this down close candle is your order block, and then you have a higher order block, down close candle, that does not pass through mean threshold, not on a closing basis. So we're seeing it trade very close to that opening price, but it's inside of the propulsion block, which is the high of the wick down to the opening. The propulsion block has a midpoint or equilibrium price point, which would be what? Consequent encroachment or mean threshold? Mean threshold. So we want to see, does price show sensitivity there? That's what I'm having annotated. So I want to see what we do there. We also have a fair value gap there. You can annotate that. I'm just mentioning it here because I want to keep the chart cleaner. So because we have that gap, because we have an order block and a propulsion block, we might have sensitivity there this week coming up. So does that mean it's going to go here and go higher? I don't know. Does it mean it goes to it and through it? I don't know that. So we have to wait and see. How does it trade on Sunday into Monday? Now that fair value gap was formed on the monthly chart. So that's why it's annotated here as monthly fair value gap, buy side imbalance, sell side inefficiency. When we get into lower time frames, this will be annotated as a weekly bullish order block, propulsion block, because it's framed and built on what time frame? The weekly chart. So the annotations are as such. The NQ weekly journal entry. The NQ continuous weekly chart respected the premium wick consequent encroachment on the weekly candle of July 17th, 2023. That's this candle here, That's the consequent encroachment, or the midpoint of that wick, and we're seeing it respected here. So this is last week's trading. It opened, traded up into it, we wicked through, took out the previous weekly high, but the bodies are staying below the consequent encroachment of that wick. And then price delivered below the previous week's low over this fair value gap and trading into the propulsion block here, right there. Now it looks like on this chart, it looks like it's touching the opening price, but it doesn't yet. We were expecting to see NQ price drop into the bullish order block, propulsion block, on the weekly candle of July 3rd, 2023. Right here. That's the propulsion block, and we are expecting this very thing to happen. So what am I doing here? I'm teaching you how to record it as you saw it coming. And then you record it here. I was not overly concerned with the initial rally higher in the first part of the week of price action. The bodies of the candles tell the narrative of price action. And again, that's annotating this very principle here. It opened in the initial rally up. That was not concerning. That was not going to be a thing that tricked us. That's not what tricked me. We were anticipating price to go up just to sucker in retail traders, the less informed, misinformed street money, and then delivery lower. So now we have these annotations here: premium, wick, consequent encroachment, and bullish order block, propulsion block. When we drop down to the next time frame, which would be what? Up here in the left-hand corner, what's below the weekly chart? The daily. So we'll have to make sure these two PD arrays are labeled weekly. So this will be a weekly premium, wick, consequent encroachment, and weekly bullish order block, propulsion block. All right, now we're down into the daily chart. Okay, so now we can see the weekly bullish order block, propulsion block now is showing it as weekly, and the weekly premium wick, consequent encroachment. Notice how much all these candles create a completely different perspective. This is why by doing this, you train your eye and you start to see how the different time frames respect the higher time frame PD arrays. And you also never get lost in the story and context of what price action is showing you across all of the time frames. So the price delivery continuum, which is moving from higher time frame to lower, from lower to higher, moving throughout the PD array matrix. Every one of these annotations here did not appear on the weekly, nor did they all appear on the monthly. Now we're on the daily chart. So the daily chart has its own specific PD arrays, but leaning on the logic and the context that would be derived from those PD arrays from the monthly chart and the weekly chart. Now we're on the daily chart, and again, it's the same symbol, NASDAQ #1 exclamation, which is the NASDAQ continuous contract. For those that have been wondering what this means, the continuous contract means that whenever the front month or the nearby contract is traded, when it expires, this chart will use the data from the new next nearby contract, and it will become the front month. So for instance, right now we're trading the September contract of NASDAQ. When NASDAQ's September contract expires, this chart, this NQ #1 exclamation, will start using the data from the December 2023 contract. So it's always using the front month or new nearby contract expiration. It uses that data to make the individual candlesticks. If you're trading with the actual futures contract, you're not trading with the NQ continuous contract. You're going to be trading with the nearby contract. So whichever one has the most open interest and highest volume being traded, most actively traded, in other words, that's the one you're actually going to be trading. And you want to do this very thing here with the actual contract. Now you're probably asking, well, why did I do it with the September contract? Because September's contract on TradingView is not going to give you the data that shows you the higher time frame monthly. So I'm using the continuous contract here to show you that higher time frame monthly fair value gap SIBI, which is this shaded area here. And then we have the daily chart showing you another PD array, which is this imbalance here, from this candle's low to that candle's high. So all of this down close movement here, this sell side delivery, not sell side liquidity, sell side delivery, it means the candlestick's expanding lower. This inefficiency is a daily fair value gap SIBI, sell side imbalance, buy side inefficiency. It traded up into the high of that SIBI on Monday. Then Tuesday, we traded down, got really close to the low, which will be this candle's high. And then we opened here on Wednesday, traded higher, created a volume imbalance, gap lower, extreme price delivery on the low end. So all this sell side delivery trades below this low here where sell side liquidity would be, and dug into this fair value gap, which is a fair value gap BISI, buy side imbalance, sell side inefficiency. This is formed on the daily chart, so the annotations have to keep referencing what time frame these PD arrays are anchored on. That way, when you go into lower time frames, you are not losing sight of what levels are what. Everything will be in its proper place, and everything will have the proper context. So if you're using the higher time frame charts to determine a narrative, a bias, where price is likely to draw to, you're going to use all these PD arrays. So now we have a silver bullet set up, which is time-based. So all these things, okay, they're potential candidates for you to build a model around that is uniquely yours. But don't try to force it. By doing this practice of annotating and logging what price action actually did, and then recording the annotations properly and organized, and then giving yourself annotations that were supportive, saying well done to yourself for seeing it coming beforehand and then delivering like you thought it would. You didn't probably do that. But again, you're tricking your subconscious, and you're tricking yourself into believing by repetition, looking at these old charts, because these journal entries will be referred to later on at the end of the week, at the end of the month. Look at previous week and the week before that. You constantly go back and look at this over and over again. So by looking at the monthly chart and the weekly chart and having those respective PD arrays annotated on the daily chart, then we look at the daily chart and identify what that time frame offers us. So we have a complete and comprehensive approach from the highest time frames, which is monthly, weekly, and now daily, and every specific PD array must be properly labeled. Otherwise, you will lose sight of what it is you're looking at. This range up here is that fair value gap SIBI on the monthly chart that was below the monthly breaker high, and between that and the monthly breaker low, which is this level here. This daily fair value gap in the form of a BISI, which is an up-close candle, this is only seen on the daily chart. And this is that monthly fair value gap, buy side imbalance, sell side inefficiency. We have a SIBI here. So it's a daily fair value gap, SIBI. The candle is down. Down candles that make a fair value gap is a SIBI. Up close candles that make a fair value gap is a BISI. Okay? So this inefficiency here forms at what part of this monthly fair value gap SIBI? So in other words, between this range high and this range low from the monthly chart now, where is this SIBI forming? In the lower half of it. Did you notice that? High to low, that pink range. Halfway point's about right here. So the high of that SIBI also is in close proximity to the consequent encroachment, which is not labeled here, of the high and low. You might want to include that in your chart. But this SIBI stops right there because not only is it the high of this imbalance, but it's also consequent encroachment of the monthly fair value gap SIBI. So now notice what we're doing. We're observing, we're appreciating and recording the logic behind nested PD arrays. There's a convergence, if you will, of PD arrays and levels that would otherwise go unnoticed by you or anyone else out there. So we also have this area here, which is a what? Fair value gap. But think now, if this is an inefficiency and it's a fair value gap, what kind of fair value gap is this? Buy side imbalance, sell side inefficiency, just like this one is down here. But what does this become if this area up here is creating some measure of a likely price delivery going lower? And then we see support behind that idea where price does this very thing here. As soon as this candle trades down below these lows and below this candle's high, which is the low of this buy side imbalance, sell side inefficiency, which is a fair value gap, this pass through of this candle here makes this and this a potential what? Inversion fair value gap. What time frame does it form on? The daily chart. See, we're up here, daily. So your annotation here is the daily inversion fair value gap high, which is this candle's low, and this candle's high, which is the daily inversion fair value gap low. An inversion fair value gap is narrative based. If we take away the context of it wanting to go lower, prior to this lower, this is just simply a fair value gap buy side imbalance, sell side inefficiency. But as soon as we have price deliver to the sell side and then attack sell side liquidity and pierce the low end range of that buy side imbalance, sell side inefficiency, this sets the tone if narrative is considered, and we've already established that early on that we were looking for lower prices. So that means we can use the midpoint or the low or the lower quadrant. Notice there's 3 specific levels there. Not a zone, very specific price levels. Midpoint, well, what's the midpoint of an inversion fair value gap? The same thing that we would call the middle of a fair value gap. The same thing we would call the middle of a wick or a tail, consequent encroachment. So we see the daily inversion fair value gap, consequent encroachment, is right there. Notice we have this inefficiency here, which is what? Daily fair value gap, SIBI. So anyone else watching my videos, if they don't really go through the process of doing this or learning or take good notes, they're going to assume that the market's going to go all the way back up to here because they'll say this is a liquidity void and the market's going to want to have to go up there. Not when it's like this. Like what? We have a higher time frame monthly fair value gap. We went up and repriced to it. We went up to it one more time, halfway, consequent encroachment. And we also rebalanced this area here because we went up into repricing it and then we left the range there. So now this is a balanced price range. And we had 1, 2 premium arrays supporting what? Lower prices. So as soon as we pierced through this low here, this level here, not that very candle, this low of the inversion fair value gap, we don't know it's an inversion fair value gap until price does this pass through. Then we can anticipate the market likely to reach up into the midpoint between this candle's low and this candle's high, and that midpoint is daily inversion fair value gap, consequent encroachment. So the midpoint between this level here and this level there. We trade up to here, trade lower, and close there. The next candle we open, trade up one more time, trading above the previous day's high, trading up into consequent encroachment of the inversion fair value gap. And what is this candle here? This big beefy candle. So we wouldn't want to see this area up here in this SIBI be traded to. We don't want to see that because above the daily inversion fair value gap high, we have this separation from this candle's low and the high, which is this candlestick low. That's the inversion fair value gap high. But then the market opens here on Wednesday. We open, rally up, and then crush the sell side liquidity, and we go below the low, the daily inversion fair value gap. That makes this low a real low of an inversion fair value gap. The market trades the next day on Thursday, it opens, rallies up, touches the low of this candle here, which is what? That's your bearish order block. It can trade to that level and up to the opening price. Can it just stop and dead in its tracks? Yeah. But what do we allow for? Coloring outside the lines. So that opening price extended forward, what are we seeing right here? The same element of price delivery that's going on right there. This is a mohawk. This is a mohawk. It's absolutely permissible. Why? Because the market dynamics and the underpinnings of the marketplace is it's wanting to go lower. So it's willing to go lower, likely to go lower. Anytime it goes to a premium array that does touch, it does deliver to, anticipate a little bit of coloring outside the lines and not freak out thinking it's going to give way, which is the reason why I have a rule of 3 PD arrays. One, the first one, it can do this and then that's all there is. It can do this and then trade into the second PD array that I would be viewing as a defense. But if I have 3 PD arrays, if I'm bearish, if it trades through 3 PD arrays, I'm probably wrong. And if I haven't been stopped out, I'm going to take the trade off and remove myself from risk. Many times, and you watched me recently trade a live trade in the NQ or NASDAQ, real futures contract, not a demo. You can see that over there on my Twitter account. I was in a trade and I had 1 PD array of the 3 breached, and it was approaching the second one. And my third one was so close and right above my second PD array that if it went to my second one, I was going to collapse the trade entirely and remove myself from risk. So it's a matter of knowing all these things that you just can't get from an ICT video one time. There's no way to compress and put all this bandwidth into one single individual presentation. Not and have the precision that you see me sharing and what my students are able to utilize when they're trading. So this area up here becomes what? Between the daily inversion fair value gap high, which is this candle's low, to this candle's low here, that makes this what? A breakaway gap. Ooh, it's not annotated. Right, it's for you to go in and dig into it. So we see it trade up into the bearish order block, opening price, and trades above this candle's high right there on Friday, which is a institutional order flow entry drill. What is that? It is a entry taken that would be inside of a imbalance like a fair value gap. What is this? It's a fair value gap. It's shaded. It's a daily fair value gap. What kind? SIBI. That means it's a down candle that delivers the fair value gap. Just the opposite of what a BISI is, okay? BISI is a fair value gap that has an up close candle. SIBI, the way you remember easy is, SIBI is sell side delivery, sell off. BISI, buy side delivery, buy up. Okay, that's the way you can remember it. We don't want to see this area traded to, because why? We have this high here that it could trade to and create a turtle soup. Trade up above it and reject and go lower, which is what it did. But how far can it go above that ICT? The opening price here, this is your bearish order block. That should change in the state of delivery right there, and it can go up to that area there and go through it just a little bit, which is permissible price action. Coloring outside the lines. And then we see delivery aggressive throughout the day and going lower, taking out Thursday's low, digging deeper into this buy side imbalance inefficiency right there, and it's a daily based PD array. The next one is the weekly bullish order block propulsion block. You can see now that we're on a daily chart, it didn't quite get there yet. That would be my next assumption for, if it goes lower, and then obviously the entire closure and delivery back to this candle's high. It doesn't need to do that. We've done enough trading into this buy side imbalance, sell side inefficiency. The close here is real close to consequent encroachment, which is not annotated here. But I want you to annotate that on your charts and look at it in the lower time frames on the Thursday's price action and Friday of last week. Now, with all that said, the annotations I have over here is that the NQ continuous daily contract delivered the lower prices I expected from the monthly fair value gap SIBI. The weekly profile, now when I say profile, I do not use market profile. I do not use volume turned sideways plotted on my charts. I don't do that. Okay. I don't use depth of market. I don't use VWAP. I don't use any of that kind of stuff. To me, they're gimmicks. If you believe in them, that's your religion. I ain't going to knock you for your religion. But it has nothing to do with why price goes up or down. Weekly profiles, to me, are like templates. What is the roadmap that price is likely to follow? This weekly profile was an obvious Monday high of the week bearish profile that formed immediately after the daily fair value gap SIBI was redelivered to on the Monday price action. That means here's Monday's price action here. We opened, traded down, rallied up to the high, which is the low of this candle. This is that SIBI, the fair value gap SIBI. It goes up here, delivers it to on Monday, and stops trading right there. Then on Tuesday, we open, trade up a little bit, and then slam lower. The weekly profile was an obvious Monday high of the week bearish profile that formed immediately after the daily fair value gap SIBI was redelivered to on the Monday price action. See what language I'm using there? The weekly profile was an obvious Monday high of the week. Now, I knew the likelihood of it forming on Monday's high, but you may not have. But in your annotations, you want to record it like you were anticipating it. Going further, Wednesday proved my bearish bias on the week was absolutely correct by creating a lower gap opening. That's this here. You opened here, traded up, you gapped from the previous day. We gapped, and then a large range candle lower. This led to an amazing large range down close day for NQ. The daily range on the Wednesday extended past the inversion fair value gap low, which telegraphed the high probability of repricing to the inversion fair value gap consequent encroachment before repricing lower on Friday's price action. That's saying this candle went below this candle's high, which is this inefficiency. So this inefficiency was a fair value gap. We went through it here. That makes this potentially a inversion fair value gap, meaning that it has a lot of probability that it's going to go up to the midpoint of it. Why shouldn't it go to the high? I just spent time talking about it. This area up here, we want to see that stay open as a fair value gap. No, as a breakaway gap. And then Friday we see it open, trades up in here, and then slams it back down. Friday was an easy short selling day with the bearish institutional order flow entry drill and bearish order block inside of the inversion fair value gap and using the inversion fair value gap consequent encroachment as the ideal premium PD array to expect the high of the day to form on. Now, this is again recording it on the context of disrespecting the fact that it's non-farm payroll Friday. Somewhere in here, you want to record that this was non-farm payroll Friday, that you wouldn't be trading that day necessarily as a new student, but you can still see and appreciate the price action and delivery of that occurring. Moving on to the NASDAQ 4-hour, you can see again all the annotations that were on the monthly, the weekly, and now the daily. See the daily fair value gap SIBI, daily inversion fair value gap high, daily inversion fair value gap consequent encroachment, and daily inversion fair value gap low, daily institutional order flow entry drill, daily bearish order block, daily fair value gap SIBI, and now we have elements inside of the 4-hour chart like we see here. The 4-hour bearish order block right here. Change in the state of deliveries there. Market opens on this 4-hour chart, trades up. What's it doing? It's trading just above that candlestick's opening price. This is permissible price action. This is a mohawk. Okay, it's just a little bit outside the lines. That's absolutely permissible. The market trades there, lower, opens here and moves lower again. This area in here is indicating that inside of this daily fair value gap SIBI, there's a little bit more detail as to why we would not reasonably expect the daily chart to see price action go above that daily inversion fair value gap high. Why? Look closer. From this candlestick's low to this candlestick's high, that is your daily fair value gap SIBI. This is the daily inversion fair value gap high, the midpoint of that inversion fair value gap, which is consequent encroachment, and the low of the daily inversion fair value gap low. So here's consequent encroachment. Why did we not expect it to trade up in this area here? On the daily, it was showing one single pass. But on a 4-hour chart, you can see it went down. And then the next candle we opened and went back up there again, and then down. Down. Delivery in here as well. So what is happening here? Went lower, 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 back up, lower. So this is what? Balanced. So this is a balanced price range. So what do we have from the daily inversion fair value gap high to the daily inversion fair value gap consequent encroachment? We have a balanced price range. Nailing the bearish order block opening price, coupling it with a confluence of the daily inversion fair value gap consequent encroachment of that gap on the daily chart that we saw trade through it here, and then we expect the midpoint of that to act as what? The high on Friday. It's not likely to go all the way through all this just to get back up into a little area here. Let me go back up to the daily chart. Think about this little area right here. Okay, now I'm going to show you that on the daily chart. That's this little area right there. Go on your own charts and you'll see what I'm talking about. This little area here is not likely to see all that trade back up to. This is going to stay open. Why? Because on the 4-hour chart, this is all balanced back and forth price action. So there's no inefficiency. There's no liquidity that's necessary to trade to. So when we trade down through the daily inversion fair value gap low here, our attention goes to the daily inversion fair value gap consequent encroachment, and the likelihood of that becoming, or just a little bit above it, like we see here, creating the Friday high. And we trade up, small little mohawk above the bearish order block, opening price, which is a change in state of delivery, just a little bit above the daily inversion fair value gap consequent encroachment here, and then we see what? Non-farm payroll rip through it and then attack the low here, there, digging into that daily fair value gap, buy side and balance, sell side inefficiency. Now notice in here also we have this down move here. In the next candle we open, and when the candle opened here, this wick hadn't formed yet. So between this candlestick's low and where we opened, this candle was just one single pass down, which would be looking much like a what? Fair value gap SIBI. But this candle does what? Immediately trades up, hits the low and goes just a little bit past it. What is that? It's permissible price action. And trades lower. That is my immediate rebalance. When it does that, whenever it does that, and you have a bias that's bullish or bearish, in this case, it immediately rebalanced here. That is one of the strongest algorithmic signatures you're going to ever see in price action. I'll have much more to talk about that in my books, but for here, I'm just reminding you that I've already mentioned it here on my YouTube channel. My long-term students know about this intimately, but this immediate rebalance is one of those things that tells you that this market's going to be extremely bearish and it's going to move fast. And then we see it run off. So we have a 4-hour PD array in the form of an immediate rebalance, and then we have a 4-hour bearish order block. Apart from that, nothing else on the 4-hour chart is anything of importance to me. The annotations here show you that the NQ 4-hour journal entry. The NQ continuous 4-hour contract shows how nicely the weekly premium wick consequent encroachment kept price from rallying higher this week. That's this level here. Okay. Tuesday bearish order block and gap opening lower was the start of the descent and subsequent sell program. That's this gap here, and bearish order block. So it's hitting that and then sells off aggressively as it enters the sell program. The daily fair value gap SIBI can be seen as well balanced in the gray area. That's this area right in here. All of this is well balanced because it's back and forth price action. It's not just one candle. It's back and forth, up and down, which reinforce the probabilities of the daily inversion fair value gap consequent encroachment being Friday's high of the day. And we see that actually occurring here. So it's going to have a real hard time getting through all this back and forth delivery when on a daily chart, it looks like it's inefficient up here when it's not. So that's the price delivery continuum that I'm referring to. You have to know what your higher time frames are showing you. And then inside of those higher time frames, you get into the details. Because as I'm showing you here, the lower time frames are going to show you a much more refined rendition of price delivery that is not always easily ascertained by looking at the higher time frame. The bias in the long-term draw on liquidity, that's the importance of those higher time frames. But the importance of the lower time frame is refining precision. It's not noise. Okay, and finally moving down into the hourly chart here. This is the last time frame we're going to look at in this presentation. So we're looking at the 60-minute chart or hourly chart, and we have all of the reference points. Now, obviously, this looks like an entirely different market now, doesn't it? From the monthly chart, the weekly chart, the daily chart, it doesn't even resemble the same market at all. But yet it is the same market. So we're using that price delivery continuum, working from the higher time frame down, looking at how each individual PD array respects and or is negated. In here, we see that monthly fair value gap SIBI, this is that shaded area here. The monthly breaker high is outside the range of this time frame. The monthly breaker low is outside the time frame of this hourly chart. Okay, so they're there. If we were to scrub down and squeeze or condense this chart vertically, it would be up here higher, and the low of the breaker would be lower than this. So for the purpose of showing the 1 hour chart time frame, the respective PD arrays and what was salient for this time frame, I've zoomed in just to show you this, but you can see this is that daily fair value gap buy side imbalance, sell side inefficiency, and the monthly fair value gap SIBI. So we know the two premium and discount levels, okay? And inside that daily fair value gap SIBI, you can see how it's important that you label your PD arrays. You can't just throw a box or a rectangle in there and assume that you're going to remember what it is and how to use it. So everything has to be organized. Everything has to have its place in all the time frames that you utilize. The weekly premium wick consequent encroachment, the 4 hour bearish order block. Now we have this fair value gap here. Where's the annotation for that? It's coupled with the 4 hour immediate rebalance and 60-minute premium fair value gap SIBI. That's this one right here. What's the candlestick's bodies showing you? Consequent encroachment, half of this gap. But what are the wicks doing? Coloring outside the lines. Just trading just a little bit outside, which is completely reasonable. But what is it touching? The previous daily fair value gap SIBI. That's not random. So I have in my notes, when I'm working with price action, when I'm trading, I have all these levels here just as a list. Just like you see price from 15,840, and then below that you see 15,800, and then below that 15,760. I have every respective PD array that I'm showing you here just in number format and its annotation label, just on a piece of paper. That's all it is. So I don't need a chart. Like I don't need a chart to trade. I just need a piece of paper and know what time it is, and I can trade off of that. So this 60-minute fair value gap is a convergence with that 4 hour immediate rebalance. What does that mean? This movement right here is this. Let me go back up to the 4 hour chart so that way you know what I'm looking at and what you're being shown. This candle here, opening, rallying up right there. This candle right there, that 4 hour candle. Inside that 4 hour candle is this right here. 1, 2, 3, 4 candles. Because 4 single 60-minute candles is that 4-hour chart. That's that market rallying back up, creating a 4-hour immediate rebalance. Then what does it do? It creates this. How could you use that? Well, if you're looking at an hourly chart, as soon as it does this complete run up and then the body closes down in here, if we open here and rally and touch the top of that fair value gap, or here's the really fun part, if we extend past that fair value gap right in here, right in there, as soon as we trade above that, I could go short there. You can go short there. Ooh, that's delicious, isn't it? Where would your stop need to be? Right above that swing high right there. Why? Because this is a fair value gap. You can't use this one. You can't use the stop right above that because it's the low of that previous daily fair value gap SIBI. It can touch that. That's reasonable. But this high here, it shouldn't go there. If it's bearish, it shouldn't go there. Why? Because this should act as a breakaway gap. Ooh, that's delicious. Sells off. And now we go back into this balanced price range. You can see again all this back and forth delivery that isn't readily available in terms of looking at on a daily chart. But now look even closer. If we take this candlestick's low, which is the high of this daily fair value gap SIBI, so this shaded pink area here, that's this candle's low to this candle's high. That's the range, okay? That creates that daily fair value gap SIBI. If we drop a fib on that candle's low and that candle's high, and you add in the 0.75 or the 0.25, whichever direction you're pulling the fib from, the lower quadrant of that daily fair value gap SIBI, that's this shaded area here. Notice what happens also on Friday. Look at the bodies. It's respecting that lower quadrant. Trades up in there. Here's a mohawk right there. Institutional order flow entry drill. Bang. Sell short. Sell side. Relative equal lows. Sell side. Hello. So I want you to know that doing these types of things, it's imperative that you are consistent by doing it. And by annotating your charts and pulling out what's obvious to you after the fact, it will help reassure yourself going forward, looking at that hard right edge, because you'll remember things by associating with them previous memories that you've created by journaling. You're condensing and compressing time in a manner with experience that didn't technically happen, but you're recording it in such a way that it tricks your brain into thinking that you did see it coming. The annotation for the 60-minute chart here is the NQ continuous 60-minute contract presented a really easy Wednesday, 2 o'clock in the morning fair value gap SIBI. That's this candle right there. When the 4-hour posted its immediate rebalance. That's this movement here. NQ can be seen respecting the lower quadrant of the daily fair value gap SIBI on Friday at noon. That's here. That's this level here. It's the lower quadrant of this shaded area. Half of it's here, and then the upper quadrant would be here. Interesting enough that it touches that. And then this one here. Now, I ain't making a big deal about that because the inefficiency wasn't created until that movement. But look, that right there, we'll talk about that in my book. As the bodies of the candles tell the narrative of lower prices into the close. And we have that there. So non-farm payroll takes out the lows here after taking buy side, then sell side. That's what non-farm payroll does. It runs both sides of the marketplace.